Many view the modern millionaire as a winner in a high-stakes game, a tech founder, an executive, or an investor who caught a single lucky break. This creates a perceived formula for success: high income plus exceptional luck plus complex strategy. However, research into actual wealth accumulation shows this equation is unstable. This perception discourages ordinary earners. When the math appears to require a massive salary or a stroke of fortune, most people stop trying before they make their first investment. Data from longitudinal wealth studies suggests a different reality. Analysis of thousands of millionaires, including findings in The Millionaire Next Door and recent surveys of 10,000 modern households, reveals a consistent pattern. This chart contrasts perceived income requirements with the actual earnings of the wealthy. 79% of millionaires received no inheritance. Furthermore, the largest group of millionaires in the data earned between $50,000 to $75,000 a year. $1 million net worth is a predictable outcome determined by the mathematical variables you apply to your current income. The first variable is your savings rate. Researchers categorize high earners with minimal assets as under-accumulators of wealth. These households often fall into the trap of proportional lifestyle inflation. As their income rises, they increase their spending on cars, housing, and luxury goods, leaving no capital to grow. This chart compares two different financial trajectories. A person earning $60,000 who saves 25% eventually crosses the total wealth of a person earning $150,000 who saves only 5%. Your savings rate, rather than your salary level, dictates the timeline of your financial independence. The second variable is time. For a middle-class earner, time provides the compounding force necessary to reach seven figures. This graph tracks two investors contributing $400 monthly at a 7% return. The top line starts at age 22, the bottom at 32. By 62, the 10-year delay creates a $500,000 gap, $1 million versus $567,000. These figures transform "start now" from common advice into a mathematical requirement. Wealth is often associated with the chaos of the trading floor, suggesting that success requires complex trading strategies or perfect market timing. The research says otherwise. A study of 10,000 millionaires found that 80% built their wealth through basic, automated employer retirement accounts. Consider a composite profile based on this data: a warehouse manager who never earned more than $48,000. By automating $350 a month into index funds, he retired with over $1 million. Reaching $1 million relies on a commitment to a repetitive, automated process rather than specialized investment knowledge. These variables are unified by a single requirement: behavioral consistency over several decades. This process begins with a leakage audit of current spending. By identifying and canceling unnecessary recurring costs, you free up the capital to fund your first automated transfers. You can sustain this by applying the 50% raise rule. Whenever your income increases, you capture half of that raise for your investments, while allowing your lifestyle to improve with the other half. Success also requires maintaining these contributions during market downturns. This screen shows a significant drop, yet the math only works if you keep buying while prices are low. This chart illustrates the psychological challenge of the long wait. For the first 20 years, your progress will feel stagnant. You must continue the habit until the curve finally turns vertical and compounding takes over. Wealth is the product of your savings rate and time, protected by emotional control. This destination is available to anyone with a stable income and the patience to follow the math. Identify the specific excuse preventing you from opening your account today. Whether it is a belief that your salary is too low or that you started too late, name that barrier in the comments. The data shows that $1 million is achievable, provided you start now and remain consistent.